Did you know that buying the dip could be the fastest way to boost your portfolio and build long-term wealth? But it's not just about buying low, you need a strategy to make it work. Hey everyone, welcome back to Third Eye Market View. If you're ready to learn how to capitalize on market dips and grow your portfolio faster, stick around. Let's dive in. Alright, let's get right into it. So, why does buying the dip work so well? When the market drops, high-quality stocks go on sale. And when you buy at lower prices, you get more shares for the same amount of money. That's powerful because it accelerates your portfolio's growth when the market rebounds. Imagine a stock falls from $100 to $80. If you buy at $80 and the stock returns to $100, that's a 25% gain. But if you waited and bought at $100, you'd be sitting at, well, 0%. That's the magic of buying low. Here's another thing, compounding works best when you start at a lower base. A 10% annual return on $100 versus $80 means a huge difference over 10 years. Even small dips can make a big impact if you're consistently buying over time. This is where dollar cost averaging becomes your best friend. Now let's talk about the psychological advantage that buying the dip gives you. During market corrections, panic sets in. People sell off their stocks, often irrationally, which creates mispriced assets and massive opportunities for patient investors. Warren Buffett says it best. Be fearful when others are greedy, and greedy when others are fearful. Buying the dip is literally putting this principle into action. Going against the herd is hard. But that's where the money is made. When everyone is panicking, buying high-quality assets at a discount positions you perfectly for the next bull market. Staying calm and focused on long-term growth when others are panicking gives you a massive edge. It's all about controlling your emotions and sticking to the plan. Let's talk about why the market always tends to bounce back, and how that benefits you. Markets move in cycles. Bear markets, corrections, and downturns are temporary. But what happens after those downturns? Historically, markets revert back to their long-term averages. Since 1926, the S&P 500 has averaged annual returns of around 10%. But after bear markets or 10 to 20% corrections, the returns are even higher, often bouncing back by 15 to 23% in the following 12 months. By buying the dip, you're positioning yourself to catch that rebound early, which multiplies your returns as the market recovers. And now, let's get into the numbers. This is where it gets interesting. When you buy during a dip, you need less of a rebound to get back to your original value. A stock that drops 50% needs to gain 100% just to get back to where it started. But if you buy at the lower price, you only need a fraction of that gain to start seeing profits. If you're nervous about timing the exact bottom, that's where dollar cost averaging comes in. DCA spreads your buys over time, which smooths out volatility and ensures you're accumulating shares at a lower average price. Let's look at some real-world examples to prove this strategy works. If you had bought the S&P 500 during the 2008 financial crisis when it dropped by over 50%, you would have seen a 400% return over the next decade. And during the COVID crash in March 2020, the market dropped over 30%. But those who bought the dip saw a V-shaped recovery, with the S&P 500 hitting new highs within 18 months. Alright, before you jump in, let's talk about some common pitfalls and how to avoid them. Not all dips are worth buying. Make sure you're investing in fundamentally strong companies with solid balance sheets, not ones that are in irreversible decline. Timing the bottom perfectly is impossible. Focus on building positions gradually rather than waiting for the perfect entry point. DCA and staying consistent during volatility will help you avoid emotional mistakes. Stick to your long-term strategy. So, why does buying the dip supercharge your portfolio? Let's recap. Lower prices mean higher upside potential. Compounding works faster from lower entry points. More shares for the same capital lead to bigger gains. Dividends yield higher at lower prices. And market recoveries are faster than people expect. When you buy quality assets at discounted prices, you're setting yourself up for outsized returns over time. It's that simple. If you found this video valuable, hit that like button to help more people discover these insights. And don't forget to subscribe for more investing tips and strategies to grow your wealth. Drop a comment below and let me know, are you buying the dip or waiting it out? I'd love to hear your thoughts. Until next time, stay patient, stay focused, and keep building that portfolio.